Good evening and welcome to F8 Audit and Assurance, class number 8, the final chapter. Ha ha ha. Okay, good evening everybody, and let me tell you what we're going to be doing in this final class. So, a quick recap on what we were doing recently, which was finishing off substantive tests in our class last week, and also looking in chapter 7 of the class notes at some audit sampling and also a little bit of computer-assisted audit techniques. So that is what we were doing. I've managed to leave chapter 7 on here. We're actually slightly further ahead than I was expecting. So tonight we've got the relatively short chapter 8, the very short but quite important chapter 9, and the nice and easy chapter 10 to finish us off with. So that is our plan. Okay, so before we get going, let's deal with any questions that are arising. Good evening, good evening, good evening. Hello everybody. Does anyone know what happened about Wednesday's session? Wednesday's session happened. It was recorded as far as I'm aware. I definitely did the session. So I'm not quite sure what the problem is. Someone did ask me about Wednesday's session and then said, oh, it's okay, I found it. That was someone internal here. So I'm pretty confident it exists. Although it sounds like one or two of you might have had a problem accessing it. I'll check it out. I honestly don't know. But I will see if we can get Wednesday's uploaded, even though it will be the same pretty much as Monday night's session last week, which should be uploaded. For safety, because I don't really know what's happened there. Anyway, enough of such things. We need to get on with it. We have material to cover. So we will make sure that something is uploaded for you anyway. So let's carry on then. And we have hit chapter number 8. Now I have titled this chapter Review. I like to keep chapter headings nice and short. What we are looking here is the final few things we do before we sign the audit report, often referred to as the completion stage. So as with many things, before you sign off the work you've done, there are a few final things you've got to go through. Now, some of these things happen during the final audit process. Some of them happen right at the very end because they have to. Now, this section of the course, this completion stage, I forget how many to be precise, but we're looking here very much at a process part of the course. So this is not one of the big core practical areas. It's still important, but it's more about knowledge than it is about applying that knowledge. There are some areas that I'll tell you about as we go where you might have to apply something, but this is not one of the big 3 core topics like substantive testing, for example. Just on the subject of ISAs, by the way, I have arranged for upload, and you should have access to this now. Some tips of what I think is coming up, the must, should, could analysis of questions, and also my summary of audit standards and knowledge in general that you need for this paper. Don't worry about last week's class. If Wednesday was a problem, which clearly it seems to have been, I will see if I can get the Wednesday class uploaded as well. Wednesday and Monday are slightly out of sync. Wednesday are slightly behind us, just to make sure that you've got it. Good, glad to hear the uploads are working at least. Okay, fabuloso. Let's get going then. with the completion phase. And the first of the audit standards we are going to come across is called subsequent events. Now remember, your examiner does not mind whether you know the numbers or not, but I will highlight the numbers as we go through, as I think in one or two places here I've not mentioned them in the class notes, which is very remiss of me. Okay, now you may well hear the words subsequent events and be thinking that sounds very similar to an accounting standard called events after the reporting period. The two things are linked, but they are not the same thing, as I will demonstrate with a little diagram, as probably the best way to get your head around this audit standard is a pretty picture. Now, I should warn you, ISA 560, compared with most audit standards, does require a bit of thinking about. A lot of audit standards are pretty basic. This one, though, a little bit harder. So let's draw a pretty picture. Okay, so there is our client's accounting year end, and at some point in the future they will have an annual general meeting, and at the annual general meeting their accounts, with our audit report attached, will be put in front of the shareholders for them to vote. If the shareholders are happy to accept the accounts, that is it. Game over, job done, accounts are sent to the authorities, and in the UK they're called Companies House. So, after your client's year end, in you come as the auditors, audit, 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 audit. And that is what we call the final audit visit. So you might remember from earlier on in the course, before the year end, audit, 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 we come in and do something called the interim audit, where we focus on planning the audit, internal controls assessment. Then on the final audit, we are checking the draft accounts that we've been handed, doing the substantive testing. At some point in that process, the directors sign off the financial statements, and then we sign our audit report. Okay, now let's start off with the accounting standard, because there is an accounting standard, IAS 10, called Events After the Reporting Period. And as the class notes will tell you in Chapter 8, or remind you, when something happens after a company's year end, usually it's next year's transaction. But sometimes things happen after the year end, which can tell us more interesting information about the company's true position at the year end. So, simple example, imagine on December the 23rd, you play a football match with your friends in the park. And it's quite a rough match and you come home limping a bit because you've hurt your foot. December the 23rd, yeah? December the 31st, your year end. On January the 5th, fed up with the fact your foot's still hurting, you go to the doctor. And the doctor takes a look at your foot and says, that doesn't look good. You'd better go to hospital, mate. You go to hospital, they x-ray it and say you've broken your foot. Well, on January the 5th, you have learned you broke your foot. But after talking to you, it's very clear that you broke your foot a couple of weeks ago when you played football on December the 23rd. So on January the 5th, you learned that on December the 31st, at the year end, you had a broken foot. You didn't know it at the time, but now you do. And if you were writing your accounts for the year to December the 31st, you would have to make it clear to everybody that your foot was impaired. So, we often find out after the year end additional information that tells us the company's true position at the year end. Number two, Let's imagine that on January the 6th, how bad luck is this, you break the other foot. Now that's not an adjusting event because on December the 31st, that foot wasn't broken. But if your shareholders have not seen your accounts yet, I think they'd want to know that you'd broken your foot shortly after the year end because that will impact your ability as a company to make lots of profits. So in other words, with IAS 10, some events that happen after the year end may be adjusting and some may have to be disclosed. So those are events after the reporting period. And the interesting bit is they are after the reporting period. But when do they stop? Because if these things can affect the accounts, we've got to have a cut-off point at some stage. Otherwise, they'll keep affecting the accounts into the future, infinity and beyond. And the rule is when the directors sign off the accounts, events after the reporting period are finished. Well, if those events can be happening at any time after the year end whilst the final audit is going on, as auditors, we have got all the way up until we sign our report what is called an active duty to audit. Because those events after the reporting period are constantly going on. So until the directors have signed the accounts, if they can keep happening, we can keep investigating. Once the directors have signed the accounts, we have to wait a little bit of time afterwards to make sure we've seen all those events after the reporting period, and then we sign our audit report. Now that is the basics. Hopefully there's nothing too difficult in there. If there's something in the accounts that you don't like, no problem. You can mention it in the audit report because the audit report comes after the directors have signed. No problem. The problem is what if this happens? At some point after the directors have signed, an error is found in the accounts. Now, you're not going to find it because you've stopped auditing. You've signed the report, you have gone home. But maybe the client finds it. And maybe the client tells you about it. And if the client tells you about it, you cannot ignore it. If the client never tells you, it's not your problem. You can't deal with something you've not been told about, and your audit's finished as far as you're concerned. But if the client tells you, I'm afraid we have to do something. Now, what we do next all depends on what the client does with that mistake. The AGM has not happened yet, which means there is time, if the client wants to change the financial statements. Let's first, though, have a look at what happens if they don't change the financial statements. Well, if they don't change the financial statements, we have got ourselves a problem. The problem is the accounts are wrong, but our audit report presumably says the accounts are right because we didn't spot it. Our audit report is currently wrong. And if the client does not want to correct the accounts, the shareholders are about to receive accounts that are wrong with an audit report that says they are right. And we cannot let that happen. Somehow we've got to inform the shareholders that the accounts are wrong. We can't put it in the audit report because we've already signed it and handed it over to the client. I mean, let's face it, they might have already sent the accounts and the audit report to the shareholders in advance of the AGM. It's too late to change the audit report. But we've got to tell the shareholders somehow. Now, how you tell them is largely up to you. You could wait until the AGM, and if the AGM is a couple of days away, I guess you might as well wait. If the AGM is still some time away, you have the right to get something sent to the shareholders. If this company is listed on a stock exchange, you could even try and arrange for a stock exchange announcement. To be frank, no one really cares. Just tell the shareholders. So, late error discovered after the audit report's been signed, but before the AGM, tell the shareholders if the client says they're not changing the accounts. But the far more interesting bit is what happens if the client announces that they will be changing the accounts. Right, so the accounts are now changed and put right. So the accounts are right. Our audit report, signed a few days, couple of weeks ago, said the accounts were right. So everything's fine, yes? Well, no. Because number one, if they've now changed the accounts, we'd better go and check. And while we're checking that correction, better make sure they've not changed anything else. But there's a bigger problem. It's not just about checking the correction. And for this, we have to go back up to the diagram. Because if the directors issue corrected financial statements, please bear in mind that events after the reporting period go all the way up until when the directors have signed. And we have not audited those events after the reporting period because we stopped. Our active duty had finished. And any one of those new EARPs might be adjusting or might be disclosable, might have broken another foot. Therefore, we have to audit the gap and then sign a new audit report. So we have to extend our active duty. I'll put this in a different color just to make this diagram a little easier to read. By the way, we have what is called a passive duty up to the AGM. Passive meaning we don't have to look for problems once we've signed our audit report, but if we are made aware of them, we have to deal with them. Bit of a messy diagram, but it's the nature of this standard. Will this not put a question mark on the auditor? It might do. If the client says, why didn't you spot this? Maybe we should have spotted it. But sometimes we do an audit, we finish, client thinks their accounts are right, we think everything's fine, and then new information comes to light after the audit has finished. A document that the client didn't realise they had received. Suddenly they open that envelope that's been sitting on their desk for a week and it gives them information they should have known about 1 week ago. Who knows? If it's our fault, yes, it will raise questions. If it's the client's fault for not passing information on to us, not our fault, is it? What if the client does not tell us? I remind you what I said before, passive duty. We only have to do anything if we are told. We cannot be expected after we've gone home to deal with issues that no one tells us about. Okay. So we'll just finish writing that underneath. If the client does correct the financial statements, check they've done the correction properly. And this is the tricky bit to remember. We have got to extend our audit work from the date of the original audit report up to today. See if there are any other things in the accounts that now need changing, and then we sign a new audit report. Now, I think most of that is not that difficult up until the last couple of bullet points. So the key is make sure you're happy that up until you sign an audit report, life is easy, because if you find a mistake, you ask the client to change it, and if they don't change it, you can mention it in the audit report. The challenging bit is, what if, after you've signed the audit report, a problem comes to light? Now, I think that standard requires a bit of practice. I would practice thinking that through in your head, because if you've thought it through in your head, it will be a lot easier to explain it with a pen if you're required to on exam day. Been a while since she's asked about that standard in a technical format at least, so don't ignore it. Okay, back to the class notes we go. So that was ISA 560. It's all explained in the notes, by the way. I just think that one needs a little bit of assistance working it through on the screen. By the way, in that previous one, subsequent events, as you can probably imagine, if the client has not yet sent the accounts to the shareholders and a late mistake is discovered, life's a lot easier because the shareholders haven't seen the original set of accounts yet. It gets a little more complicated if the client's already sent the accounts and the audit report to the shareholders in advance of the AGM. Because if they have, and now you're suggesting that they have to send a new set of accounts and a new audit report, we'd have to make sure that both the new accounts and the new audit report have a little note in them explaining that the previous version that the shareholders saw should be ignored. Now, all of that is covered in the notes, but to be honest, if that question came up on exam day, the stuff I've just said but not written down is beyond what you need to get full marks. So it's true, but I wouldn't worry about it too much. Okay then, on to the next one. Now this is quite important, and this is linked to audit reports that we're also doing after this chapter. What if the error is spotted by one of the shareholders after the issuance of the financial statements and the audit report? Well, in most cases, the shareholders don't work at the company, so I'm not entirely sure how they would know the accounts are wrong. But to answer your question, both the directors and the shareholders, directors and the auditors would look pretty stupid, wouldn't they? And it does happen sometimes. I may have mentioned Tesco's already on this course. It wasn't a shareholder who spotted it, but in 2014, 3 months after the accounts had been issued, and about 2 months after the AGM, someone went to Tesco's management and said, the accounts are wrong. We all know the accounts are wrong. You're not doing anything about it, so I'm telling you. And it all went public after the AGM. So yes, it can be very embarrassing. Okay, let's move it on. Our next standard, other information, is Audit Standard 720, and as I was saying, this one links to Chapter 9, Audit Reports. Now, the notes are fairly short and concise on this, which is fine, but I am again going to go to a separate page and give you a little bit extra. This is all to do with the fact that if we are auditing a fairly big listed company, what the shareholders are going to receive is not just the financial statements with the audit report, because what they're also going to get is the company's annual report. So typically they get a big glossy document. If it's a bank, it will probably be about 500-600 pages long. Yes, really. Called the annual report and accounts. The annual report is where they're going to get things like, the chairman's statement, lots of corporate governance disclosures, report of the audit committee, report of the remuneration committee, just linking back to the beginning of the course, chapter 1. Bit of corporate social responsibility. So stuff about the company's impact on the environment, how it looks after its staff, customers, suppliers, blah, 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 blah. Now, the issue here is quite straightforward. That little lot is not subject to an audit. Not our job to audit that stuff. Well, if we're not auditing it, why do we need an audit standard on it then? Seems a bit weird, doesn't it? Well, here is the potential for a problem. And maybe the best way to deal with this is with an example. So what if the financial statements show, what should we do? Let's have charitable donations of $1 million during the year. And the audit report says the financial statements are true and fair. So we've done our audit work, and yes, we agree that they've donated $1 million to charity during the year. But charitable donations are also going to appear in a corporate social responsibility report. And what if the company's CSR report says donations were 10 million? We have got ourselves a little bit of a problem. The accounts which we have audited are fine. The CSR report, which it's not our job to audit, is wrong. And that is going to confuse the shareholders because they're receiving both. And the shareholders might now think our audit report is wrong and that the CSR report is right. And we cannot have our audit report's value undermined like that. Therefore, we cannot allow that situation to continue. So the first thing we will do, fairly obviously, is ask the board to correct this. If the client says yes, then all is well and good. If the client refuses, what do we do next? You see, the problem here is we need to tell the shareholders about this, but we do not audit that document, which means we cannot give an audit opinion on it. So what we are going to do is we do not change the audit opinion. We will still say the accounts give a true and fair view, because they do. But what we're allowed to do in an audit report, as you'll see shortly, is we add a paragraph. And this one is called an other matter paragraph. And as you'll see in Chapter 9, these things go underneath the opinion, and thus the shareholders have been informed. Now, some of you might be looking at this and thinking, hang on a minute, if we don't audit the annual report, why would we know there's a mistake there? How would we see it? And the answer is, we're not going to audit that annual report, but we are meant to read it. What's the difference between reading and auditing? Well, at the weekend, I read in the newspapers that Manchester United had beaten West Bromwich Albion 2-0. I read it. I didn't go to Manchester and ask lots of people who were at the game, can they confirm that definitely happened? I read it, and I've assumed it's true. So that's reading. Auditing would involve reading that Manchester United won 2-0 at the weekend, and then going to Manchester or watching the highlights on the television or phoning the BBC or something to try to check whether that result is correct. So the logic is the auditor is meant to read the annual report. You don't have to check anything, but if you see something you know is wrong because it links to the accounts, which you know a lot about because you've audited them, then you're meant to do something about it. So you read this other information, this annual report. If you find anything inconsistent with the accounts, ask the client to change it, and if they won't, put it in an other matter paragraph. Oh, we've got a Manchester United fan. Fantastic. Isn't that delightful? I suppose I should mention that Manchester City are still... Anyway, let's not go there. Going to be an interesting season, isn't it? So that is ISA 720. Hopefully nothing too complicated there. Let us move on to what is next. And it's another audit standard. But this one, I think, is relatively straightforward. This is Audit Standard 570, and there are 2, maybe 3 potential exam questions here. The third one we will deal with in the audit report chapter. For now, we'll deal with the other 2. Okay, now as we should know from our accounting knowledge, accounts are prepared under a going concern basis. We should also remember that if there are any threats to our client's going concern status, they should have disclosed that threat in a note to their accounts. So, since going concern affects the accounts, my job as auditor is to look at our clients' future prospects to decide if we agree with their own assessment of whether they're going to survive or not. In other words, we've got to work out if we think our clients are going concern. Now that raises 2 potential exam questions. Here's one of them. Where you're given a story and you're told, please identify any clues in the story that the company is in trouble. Now I think this is one of the easiest questions that can come up on F8, because she's going to have to give you information that tells you they've got problems. You know, things like they're making lots of losses, they're running out of cash, they desperately need a bank loan, their customers are leaving, their suppliers aren't happy and want to be paid in advance, their best staff are leaving, they haven't paid the taxman in the last 5 years, etc, etc, etc. So if you're asked for clues that a company is not a going concern, it will be with a story, and the story will be loaded with them. The only thing I would say is avoid just copying the clues out. If it says they haven't paid the taxman for 5 years, don't write in your answer, they haven't paid the taxman for 5 years. Write, they haven't paid the taxman for 5 years, and at some point the taxman is going to take legal action and get this company shut down. Add something to it. So that is really straightforward. The bit that's a little harder, which means you've either got to memorize it or practice it, I suppose, is what's at the bottom of the page. Also a potential exam question, which is how do you actually tell if a company is in trouble? Well, generally, companies will survive if they've got enough cash to pay the things they have to pay for. Now, notice I say have to pay for. An advertising campaign, in most cases, could be delayed. Training of staff could be delayed. Paying the tax authorities, paying your staff salaries, paying that very important supplier who, if you annoy, means you have no goods anymore. Those sort of things you probably can't delay. Replacing the machine that's broken down and without it you can't operate, you have to replace it. So as an auditor, how do I know if my client is likely to survive? Well, the first thing I'll do is find out how much money they need. Get hold of their forecasts, have a look at the assumptions behind their forecasts, go and take a look at which numbers in there they have to pay and which numbers they could avoid if they have to. Now, I'm talking about money going out. I also look at the money they project to come in and assess how safe it is. If they're projecting massive increases in sales, well, do we know that's going to happen, or is that them just being very optimistic? So the forecast will tell me how much cash they're likely to need. What I then do is look at two other things. How much cash have they got, and how much cash could they get in a crisis? How much cash they've got is easy, bank statements. How much cash they could get, well, how do you get cash in a crisis? Loans, shares, or sell stuff? So loans, I'd look at things like their gearing ratio, see how many loans they've already got. Have they always paid things back on time? If they have, other people will probably lend them more money. Look at the assets they've got. A lot of loans require security. Have they got buildings, other big assets which they've not yet used as security? Because that could make it easier to borrow. Look at correspondence with the bank and see what the relationship is like. If there's lots of letters that look rather angry, I'm guessing more loans aren't coming. If the bank seem happy, maybe it's okay. Shares, look at their relationship with shareholders. If 6 months ago they asked the shareholders for more cash, I doubt if they ask again now, the shareholders will be very happy. And then look and see if they've got any other ways of raising money. Do they have spare assets they could sell? Things they don't really need to keep hold of to keep the core of the business running. I'd then look at the rest of their statement of financial position. Receivables. If lots of people owe them money and they're struggling to collect it, maybe they could raise cash by giving a discount for prompt payments. Maybe they should employ debt collectors to go and get the money for them. And those are the audit procedures I would do. I'd focus on their forecasts, how much cash have they got, and look at how much cash they could raise. So that is going concern. Past exam question 2A in June 15 exam. Is that okay to write answer as the class not provided? Sorry, I don't think I understand the question. Oh, sorry, if you're asking for an answer to June 15 exams, yeah, of course. Book on the revision course and you'll get the answers. Because most of what I'm doing on revision is going to be recent exam papers. So that's one of the benefits of booking on revision. Anyway, let us carry on. That was going concern. And now it is time to move on to another audit standard and ISA 580. Although I notice in the notes I have actually mentioned this one. In terms of past exam question answers, by the way, you will be receiving uploaded in the next day or two June 2013, December 2013 answers. So you'll get those in addition as well. If you want anything more recent than that, come on revision and you'll see me working loads of questions. Right, ISA 580. When we were doing substantive testing, one of the things I said as an audit test was enquire and confirmation. We're going to ask people to tell us things. Now, sometimes that is confirming a fact, but sometimes there are estimates in the accounts, and those estimates are the job of management to come up with. And we need something in writing to confirm that at the date we finish the audit, management are still happy that those estimates, those matters of opinion, are still their belief. And that is largely what this management representation thing is all about. Because right at the end of the audit, as late as possible, preferably on the day you sign the audit report, so that these things are current, we are going to get something called a management letter of representation. What we do is we go to our client's management and we tell them, here's a list of things that we need you to confirm in writing to us. Generally, they are things management have said during the audit and we just need them in writing. We hand the list to the client, and if the client's happy with that, they will turn this into a letter from them to us. They'll sign it and they'll hand it back. If we're going to get them to sign this, it's a useful opportunity to do a couple of other things as well. So things like this at the top of the list, and also that one, are management confirming various legal matters. So now the audit is almost finished, confirming that yes, they gave us all the evidence, yes, the financial statements are their responsibility, and yes, they've put everything in them. So if we're going to get them to sign something, we might as well add a few useful bits on the end. But things like related party transactions, which are very difficult for auditors to know about. Subsequent events, remember they've happened after the year end. They might have happened very recently and we might not have been told about them. What else? Going concern, another matter of opinion. So the idea is, wherever there are things in the accounts that are subjective, estimates, matters of the director's opinion, we get them to confirm it in writing. Again, if there are outstanding debts and we're not sure whether they'll receive them or not, if the directors say, yeah, we're sure we'll get the money, fine, get them to write it down then. Okay, that is management representations. It's a good general test to be aware of, because wherever you are auditing anything that is subjective, the value of inventory, whether debts will be recovered, whether all legal cases have been disclosed, anything like that, get management to confirm it in writing. Okay, we are almost at the end of this chapter. Whoops. Whoa, no, wrong way. There we go. Almost at the end. Right at the end of the audit, we are required to do something called overall review. One of the elements of overall review is based on ISA 520. Now, ISA 520 is called Analytical Procedures, We mentioned this actually earlier in the course, so a useful opportunity to remind ourselves. Let's come down here. So analytical procedures, my rather messy handwriting, sorry about that. Analytical procedures are done at 3 stages of the audit. They're done at the planning stage, they might be done as part of evidence collection. That's substantive testing, by the way. And as we're seeing now, they're done at the end of the audit. Okay, think about that question. You've just said to me, what if you think the doubtful debts won't be received and the directors think they will? Whose report is it at the end? It's the auditor's report. Whose opinion is it? The auditor's opinion. If you disagree with the directors, you say, we don't think they will be collected, the accounts are wrong. It is your opinion. And you're never going to believe the directors what they say. You must get other evidence to check what they've told you. You can't just rely on what I mean, on that basis, they could say the accounts are true and fair. You're not going to rely on that, are you? And just say it wouldn't work. So no, it is your opinion. You get other evidence to test what the directors have told you. Okay, analytical procedures. So, at the planning stage of the audit, what did we do? We checked the draft financial statements against our expectations. And why did we do that? We did that because if our expectations didn't match the draft accounts, it might suggest that the draft accounts had mistakes. And of course, at planning stage, most of the work we're doing is to highlight risk of misstatement. Well, at the final review stage, we're going to do exactly the same thing again, except now it's the final financial statements we compare with our expectations. The idea being that by the end of the audit, the accounts have probably changed from what we saw at the beginning, but also our expectations have changed because we've learned more about the client during the audit. So those 2 stages are effectively doing the same thing twice, once at the beginning and once at the end. Evidence collection as substantive testing, by the way, I'll show this in a different colour because it's a rather different thing. For example, we compared depreciation policy with competitor companies because we were of the belief that if all similar companies have a similar depreciation policy, that gives some evidence that it's probably right. So evidence collection analytical is much more specific aimed at individual numbers in the accounts to try and prove it looks about right. Okay, so that is analytical procedures at the final stage of the audit. So that's what it's getting at when it referred to ISA 520, analytical at the final review stage. Just realised notes are up here, aren't they? So that's one thing we need to do. Another thing we need to do towards the end of the audit is make sure we've finished our audit plan. We had an audit plan to do certain work and to collect certain evidence. So we'd better make sure we have got sufficient evidence to be able to give an opinion. Thirdly, uncorrected misstatements. Now, during the audit, we will have discovered mistakes. If we find one mistake and it's material, we will have asked the client to put it right. But we will also have found other smaller mistakes that individually are not material. So what we have to do at the end of the audit, in fact we'll put this down at the bottom of the page, oh dear, as well, got a bit of space there. In fact we'll put it on a separate page because we're running out of space here, aren't we? Is what we got to do is add up all the immaterial mistakes we found because lots of little mistakes can create a big mistake. Now, if those little mistakes add up to a problem that is material overall, then the accounts are not true and fair, and we'd have to go to the board and say, right, here's a list of smaller mistakes. You have got to correct at least some of these. Otherwise, we'll have to mention it in the audit report because your accounts are too far away from the truth. They won't have to correct all of them just to get underneath the materiality figure. But some companies want to put everything right. They don't want any mistakes in there, big or small. So at the end of the audit, pass the list of mistakes to your client, suggest they want to put them right, and make sure they put enough right so that when you add up anything that's left over that is still wrong, it is not overall material. One more thing I should say actually in here, just add on to the end. Now you don't have to do this right at the end of the audit, but it seems like quite a sensible time to do it. The logic of doing it at the end, although you'll probably have considered their policies as you've gone through the accounts. So you've considered depreciation policy when you did tangible non-current assets, is that deciding which accounting policy is appropriate for a company involves understanding the company. So based on the same logic as this, that your understanding of the client has developed during the audit, it makes sense at the end to have one final look at their accounting policies and say, based on what I now know about this company, do those policies look sensible? I should also mention that auditors fill out lots of checklists at the end of the audit. Make sure that everything that should have been disclosed under the Companies Act has been disclosed. Make sure there's no accounting rules you've forgotten about. So there's lots of checklists we fill out. It's a bit like shopping lists, isn't it? Last thing you do before you leave the supermarket is go through your shopping list and make sure you've not forgotten anything, and auditors are no different. But that is the end of the audit process. We've finished auditing and we can now sign our audit report. So Chapter 8, as you've seen, is an audit standard, then another audit standard, then another audit standard, then another audit standard. It's a mixture of little audit standards that are all done at the end of the audit process. Individually, none of them is worth more than about 6 or 7 marks maximum. And I would normally expect on your exam one of these audit standards, possibly 2, but typically 1, to come up and you've got to explain something about it. So it's good knowledge to have. Okay then, we are nearing completion of our course. And the last core area is audit reporting. We finished the audit, we planned it, we identified risks, we assessed our clients' controls, and then we did substantive testing. And between the controls assessment and the checking the numbers ourselves, we have collected sufficient, appropriate evidence. We've done our finalisation work, and now it's time to issue our report. For the exam, there's only really 2 things she can do here. She might ask you what goes into an audit report. That's just knowledge, it's not very exciting, and if you know it, you know it. The bit that causes students trouble is this. Because there are 7 possible conclusions on this course with audit reports, and there are rules, and you need to know these rules so that you can apply them to scenarios. And the biggest problem is it's very clear a lot of students just do not know the rules. Now, this is not something that will come naturally. You won't guess this. This is something you have to learn. There aren't that many things on this course that I would describe as critical knowledge. This is one of them. If you don't know it, you are not going to pick up marks. Right, off we go then. We start off with the content of an audit report. Audit reports are given in an audit standard. I'll talk more about that standard in a minute, although it's referred to up there, look. So all audit reports are meant to pretty much look the same. The first few sections are not very exciting. And the reason they're not very exciting is they are required, but they're the same pretty much every time. So there's nothing the examiner really can do with them. The title will normally say Independent Audit Report. The addressee is typically the shareholders. And there'll be an introductory paragraph explaining what you have audited. So you know the financial statements of ABC Company for the year ending, whatever the year end is. And to make it clear what you've audited, you list the items. So we have audited the financial statements for the year ending blah, 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 comprising the statement of profit or loss, the statement of financial position, if there is a statement of cash flows, that as well, and the notes to the accounts. There's then a legal section saying directors are responsible for preparing accounts, auditors are responsible for giving an opinion. But as I said, those sections are less important for the exam because they are standardised. The bits we've got to look at are at the bottom. Now I should also say the signature and date is not very exciting, so that also is less important. The interesting stuff for us is here. Now, fairly obviously, the opinion is your opinion, and the basis of opinion I can't really explain without taking you through the outcomes. The next bit, not really important for F8. Audit reports, there is a standard saying what the report should look like. But audit reports are so important, governments will set law on them as well. Which means if you look at audit reports in 20 different countries, you will see documents that are slightly different. So the section next, this bit here, which is not important for the exam, is just to highlight to you that in different countries, governments may have added additional reporting requirements. So for example, in the United Kingdom, as well as giving an opinion on whether the accounts are true and fair, we also have to give an opinion on something called a director's report. You don't need to know that. Just be aware there are additional reporting requirements possible. Now, one question you might be asked is, we have an audit standard on audit reports. Is that a good thing or a bad thing? So standardized audit reports. Would we rather have standardized, or would we rather they varied? Well, the arguments for and against standardized audit reports are pretty similar to the arguments for and against standardized working papers that we saw back in chapter number 3. Standardized is good because the shareholders reading the audit reports would have familiarity with what they're reading because they've seen the same report at lots of different companies. It's also good for training the auditors because they're doing the same thing every time. But whilst it does have some good points, standardizing things can also have some bad points because standardized can get very boring very quickly. And a lot of people have complained about audit reports that auditors want to tell the shareholders as little information as they can get away with, because the less you say, the less can be wrong. And there's been a lot of pressure in recent years to stop standardizing audit reports and force auditors to be a bit more ingenious with what they tell us. Okay, the really important bit of the chapter though is coming up next with the outcomes. And so, since this is important, we are not simply going to read it off the page. No. I'm going to help you and do this on a separate page and add some information. Okay then. Right. Now there's various ways I can lay this out. I think we will do it in a series of questions. So, question number 1. So I need to sign my audit report, and that means I need to give an opinion. And the first question we have to ask is, was I able to get enough evidence? Because that is going to affect my opinion. If the answer is yes, then we can move on to question 2. But what if the answer is no? Well, if I haven't got enough evidence, that is going to have an impact on whether I can give an opinion or not. And it all depends on whether the missing evidence relates to a small number of balances in the financial statements or lots of balances. Now I've said 1 or 2 to keep life simple. There is no cut-off point with this. It is up to the auditor's judgment as to how many balances it affects and when that becomes a bigger problem. Let's keep it simple and just say 1 or 2 or lots. Let's start with 1 or 2. Okay, so if it's only 1 or 2 balances and you've got evidence for everything else, then most of the numbers in the accounts you can say whether they're true and fair or not. The problem is these balances because you're missing the evidence. What you're therefore going to do is issue something called an except for opinion. Now this is known as a qualified opinion, and it's called except for because those are the words you're going to use. You see, what you're going to do is in the basis of opinion, which is the section above the opinion itself, you are going to explain the missing evidence. So tell the shareholders what you couldn't find. And then in your opinion you can say, except for the missing evidence above, in our opinion, the financial statements give a true and fair view. So that is known as an except for qualified opinion. If, on the other hand, the missing evidence relates to lots of balances in the financial statements, so you turn up to do the audit and they say, I'm really sorry, the dog has eaten the accounting records. A computer virus has wiped out the accounting records. Well, now you can't give an opinion at all. And that is called a disclaimer of opinion. And the words you will use now are, we cannot or we do not give an opinion. Now, when we say lots of balances in the financial statements, there is a word for that. It is called pervasive. So now the problem is not just material, it affects the overall view of the accounts, and that's what we mean by pervasive. Something that pervades is something that gets everywhere. It doesn't just affect one corner, it affects everything. Okay, so there we have got our first 2 outcomes then. Except for lack of evidence, disclaimer of opinion, big lack of evidence. If we've got the evidence we wanted, we move to question number 2. Well, if we've got the evidence, we can form an opinion. So the next question is, are the financial statements materially, hang on, let's just get this consistent with the above. Okay, I'm going to change that word, do it the other way around, I think. Are the financial statements true and fair? Well, if the answer to that question is yes, we can go to question 3. If the answer to that question is no, then we have a similar situation to what we saw up here. Because if there is a material misstatement, but it only affects 1 or 2, affects 1 or 2 balances in the financial statements, then just as we did above, we are going to give an except for qualified opinion. And just as we did above, in the basis of opinion section, above the opinion, we explain how the financial statements are wrong. So very similar to the previous one. Now we're going to say, basis of opinion, under IAS 2, inventory should be recorded at the lower of cost or net realizable value. Based on the work we have done, we believe that $1 million worth of inventory in the accounts is in fact only worth $600,000 to sell, meaning inventory is overstated by $400,000, as is the company's profit. Opinion. Except for the adjustments required as above, the financial statements give a true and fair view. So you notice here that if we can highlight the specific mistake or problem with evidence that we've found, we highlight it. As you've probably already predicted, I am going to write, if this misstatement is in many financial statement balances, and again, that word pervasive is relevant. Well, now we can give an opinion, but the opinion is the entire financial statements are not true and fair, and that is known as an adverse opinion. So, we have now had 4 of our 7 outcomes. 2 of them related to a lack of evidence, material, and pervasive, really material, and 2 of them related to misstatements in the accounts, material, 1 or 2 balances, pervasive, really material, affecting loads of balances. So that was question number 2. We now get to question number 3. Now, presumably, if we've reached question number 3, we've collected all the evidence and the financial statements, it appears, are true and fair. So if we've got this far, no problem with the accounts. And since there's no problem with the accounts, the audit opinion will not have to be modified. Meaning it will say, in our opinion, the financial statements give a true and fair view. So what's the question then? Well, it comes in 2 parts. Question 3A. Are there any inconsistencies in the client's unaudited annual report? This is what I was getting at earlier. I'm going to remind you here of ISA 720, which was the audit standard looking at this, because we've read the annual report, haven't we? And if there are any inconsistencies in the client's annual report, if that is a yes, then we know that we have to add an other matter paragraph under the audit opinion. And finally, question 3B, which says the financial statements are correct, But is there anything really important in there? In the disclosure notes, because that's where all the explanations are, that we would like to highlight. So the financial statements are right. I'm not saying they're wrong, but if there's something in there really, really important that you think you want to make sure the shareholders have seen, then we will. And what we do is we add an emphasis of matter paragraph. Now this also goes under the opinion. So there are two more outcomes then. Not changing the opinion anymore, but two extra paragraphs that can appear underneath the audit opinion. So we've had two things due to a lack of evidence, two things because the accounts are wrong. If the accounts are fine and we've got our evidence, we've got two additional paragraphs that can happen. Well, that's 6, which means we've got 1 left. That was question 3. And if 3A and 3B are no, then we get outcome number 7, which is a totally unmodified report. Nothing changes at all. Now I could have done that in the opposite order and started with the unmodified report, because the unmodified report is ISA 700, the basic audit report. And if you went out into the real world and read audit reports, 95% of them are that last one up on the screen at the moment. In exam world, of course, it needs to be more interesting because you need to know about the alternatives. Just to throw in some audit standards at this point, there are 3 of them involved here. ISA 700 is the last thing I just did. This is the basic unmodified report. ISA 705 are the 4 examples of the modified opinion section. Which was except for and disclaimer for lack of evidence, and then except for and adverse for misstatements. And then ISA 706 is where you leave the opinion section alone, but you modify, in other words, change the report by adding an extra paragraph. And as we've just seen, there are 2 potential extra paragraphs you could add. An other matter, an emphasis of matter. Whew. Well, those are the rules, and if you understand those rules, everything's great. Because if you follow this through in the class notes where it's all explained, there you go, there are all the examples. That's it. That is Chapter 9. Knowing the contents of the report and the 7 outcomes. And what we're going to do now is a couple of examples just to try to ensure that understanding is in there. Right, here we go then. Example number 1. Your client has a profit figure of $10 million. It has inventory of $2 million at cost, but the net realizable value is only 0.8 million. And on the statement of financial position, it's valued at cost. Well, looking at that example, what can I see? I can see the inventory is overstated by 1.2 million. The profit of this company is 10, so that's 12% of profit. Now, I don't know if you remember this way back in chapter 4, I think it was. No, 3. When we looked at materiality, we start to say something is material if it's at least 5% of profit. 12 is bigger than 5. And therefore, this is a material misstatement. Okay, so I've identified this is not about missing evidence, this is about a mistake in the accounts. There were 2 possibilities with mistake in the accounts. Does it affect just 1 or 2 balances, or does it affect loads? Well, this is a material misstatement which only affects the inventory figure. I would therefore write it only affects inventory, so it's not pervasive. Therefore, the answer is going to be an except for qualified opinion and above the opinion, that basis section I referred to will explain the mistake. Okay, so there we go with example numero 1. Right, let's now change the story. Your client has recently lost its biggest customer. It affects the profit as well, but in a positive way. Okay, 2 things about that statement. How is it affecting the profit in a positive way? You've just lost 1.2 million of your inventory. Trust me, that makes profit go down, not up. Inventory is in cost of sales as a negative, which means that figure's just gone down, which means cost of sales has gone up. Number 2, profit is not a number in the accounts. It is not a balance. It's a subtotal. You do not debit credit profit. So profit is not an additional number. Profit is wrong because inventory is wrong. Profit is just a total. I'm talking about individual balances we can debit or credit. Okay? Okay, example 2. Client's recently lost its biggest customer. 70% of its sales last year were from that company. Now, before you try and come to a conclusion, you cannot do that yet. Part 1. The client has fully disclosed this in a note to their financial statements, or 2, the client has made no mention of this in the financial statements. So we're going to have 2 possibilities. Right, firstly, number 1. If your client has recently lost its biggest customer, and that is 70% of sales from last year, I would suggest that your client might have a going concern problem. And if we as auditors agree that this company has a going concern threat, which it would seem to, then under IAS 1, the company should have disclosed the threat. But then it has. And since it has done what it's meant to have done, the financial statements are true and fair. And if the financial statements are true and fair, the opinion in my audit report will be unmodified. Now, what this is telling us in the question thing that I did earlier on is we've gone through question 1 and question 2 and we've reached question 3. The accounts are fine. What have I got left to ask? Well, there's no mention of the annual report here, so it's nothing to do with that. But 3 part B said, is there anything in the financial statements that they've got right, but is so interesting you'd want to tell the shareholders about it anyway? I would say a going concern threat is fairly interesting. So what we do is add an emphasis of matter paragraph to tell the shareholders to read this financial statement note. As the name suggests, it is an emphasis of something. We are simply highlighting something in the accounts so important we want the shareholders to read it. Typically, if we're doing an emphasis of matter, it's going to be something to do with going concern. It needs to be really important. Okay? If you want a good example of this, BP, the petrol company, well, 4 years ago, they had an oil rig explode, filled the Gulf of Mexico with oil. I think 11 of their staff died, and it's caused all sorts of environmental damage. And BP have been paying billions in fines. If you go and find the BP annual report, you will find underneath the audit opinion an emphasis of matter paragraph. What about part 2? What if the client has made no mention of this in their accounts? Well, if they've made no mention of this, then they are breaching IAS 1 And failing to disclose something is just as bad as getting your debits and credits wrong. That is a misstatement. Now, there's only one thing wrong with the accounts. They're missing a disclosure note. And therefore, I suspect I would say an except for qualified opinion is the most likely outcome. However, it could be argued that because the missing note relates to going concern, and going concern relates to the position of the whole company, it's about the company's very existence, you might possibly argue that this could be adverse. And say that without that one note, it totally changes what the shareholders would think about the company. If they didn't know that this customer had been lost, it would totally change their view. And you could see an argument for that. Now, I said this before and I will repeat it now. Deciding whether something is material and except for, or pervasive and far more important, is a matter of auditor's opinion. And two different auditors in one situation might come to different conclusions. On F8, it will typically be very, very obvious whether it's material or pervasive. But don't be afraid of picking your answer and then saying it might be the case, if you think it is, that it could be argued the other one. There's one more thing I'm going to do with this example number 2. Turn it into example 3 and say this. Your client has lost its biggest customer. Directors think company will survive. And have prepared the financial statements on the going concern basis. You believe the company will not survive. So what's the outcome going to be here? Well, if you don't think this company will survive, it means that you are disagreeing with the entire basis of preparation of the financial statements. You're not just disagreeing with one number or two numbers, you're saying the way these accounts have been put together is just the wrong way. And that has to mean an adverse opinion. You don't need to know this in full detail for F8, but if you're not using the going concern basis to prepare accounts, you have got to use something else called the breakup basis, and that will totally change the accounts. So if you disagree with the directors on whether the company is a going concern, then that is going to be adverse. Well, there you go. There are some examples for audit reports. Don't forget, in the previous chapter, we had the donations where they were correct in the accounts, but wrong in the annual report. There's an example of an other matter. and you have got to work your head around those various outcomes and practice them. Being fairly technical, and there's not been much technical on this course to be honest, that is something where the best thing you can do is leave it for now, come back to it maybe later tonight, tomorrow, a couple of days later, revisit it. This one needs some repetition. You've got to keep looking at it in order to get it into your head. Right, so there we go. The good news is we have now covered all the difficult, I suppose, bits of the course. And the last thing we've got to look at chapter number 10 is internal audit. This is left till the end of the course for two reasons. Number one, it's knowledge only. And at the end of a course, at the end of a 2-hour evening class, we don't really want to be doing something that involves too much thinking and application. What we want is something where I can say, learn that, memorize that, and it makes our lives easier. The second reason I like to do this at the end of the course is I like to separate the external audit process, checking the accounts, and internal audit as something separate. So there are various bits of knowledge in this chapter, which we are going to go through. So let's take it through, and I will point out when we get to something important and how it might come up. Firstly, a reminder from Chapter 1 that internal audit is part of the corporate governance of a company. Companies need good control systems to help manage their risk, and directors need to know that the control systems they have in place are working. And that is what internal auditors are primarily there to do, to report back to the board as to whether the controls are effective. Are they both working and are they doing the job they're meant to do? Now you'll notice in the bit that I've just circled there, it says a team of auditors who may be from inside or outside the company. Internal auditors are called internal auditors because they are reporting internally. It is not because they are inside the company. Some companies will have their own internal audit department with employees, but some companies will outsource the internal audit. They will pay outside experts to come in and do their internal audit work for them. Keep that thought, it's coming up in a minute or two. I've put audit committees into Chapter 10 just to remind you that they are related to internal auditors. The audit committee will decide if internal audit is needed, and we'll come back to that point in a minute as well. The audit committee will decide if we should have our own employees to do the internal audit or whether it should be outsourced. The audit committee will help set a budget for internal audit, and when internal audit finds something scary like fraud, they will report it to the audit committee, which is why, as I said, it's been dropped back into Chapter 10 at this point to remind you of the link. So, just as a bit of early comparison, more of this coming up in a page or two, a reminder that external audit is there to make sure that the accountability side of corporate governance is being dealt with by making sure that the company's financial statements are true and fair. Whereas internal audit are going to be focusing on internal controls. Now, I'd just like to expand on that point, if I may. Down at the bottom of the page, as you can see up on the screen there, it says internal audit will be involved in. And I'd just like to expand that a bit more. Whoops. So, reporting to the board on the effectiveness of risk management, good. Effectiveness of internal controls, yes. They may well advise on corporate governance requirements because companies don't want to breach corporate governance. I'm going to add a bit on that in a second. Fraud investigations, yes, and whether the internal management accounting systems are producing reliable information. Okay. Just going to add a couple onto that. Companies need to know that their assets are safe. So another thing that internal audit may well be asked to do is go around the company and make sure the assets are still there. One example of that is, of course, a stock take or inventory count. And I'd expect internal auditors to be turning up to that event, partly to make sure it's running properly, and partly so they can satisfy themselves that inventory is not being stolen. Companies do not generally want to break the law. Internal audit, therefore, might be asked to take a look at the laws and regulations the company should be following and take a look to see if the company is breaking any. One of those could be corporate governance. So that's an example. But a wider legal and compliance, checking that health and safety is not being breached, industry guidelines are being followed, etc. Okay, well there's a few things that internal auditors do. Another potential exam question is a simple comparison of internal versus external auditors. As you can see from the table up there, nice and clear. I would just learn this, by the way. You can also see I've put 5 different criteria into that table, which means this could easily be a 4 or 5 mark knowledge question. External auditors, all about the shareholders and the financial statements. Internal auditors, appointed by the directors, reporting to the directors. Notice legal requirement. External audit, most companies have no choice. They have to have their accounts audited. Internal audit typically is not a legal requirement. Which I suppose raises another potential question. Why would you have it then? I mean, if you don't have to have it, what's the point? Well, there are various reasons. It reflects good corporate governance. It looks good. It is a recommendation to have it. It gives assurance to your investors that you take controls and risk management seriously. As a result of that, it should help to improve your controls. But you might think, I don't need my controls improving. My controls are fabulous. However, if you have suffered a lot of fraud recently, if the company is growing, or becoming more complicated, those could be very good reasons to put internal audit in place right now. Going back to the first point, it reflects good corporate governance. Why would you care too much about corporate governance? Well, if you are about to list on the stock market, your corporate governance is going to come under much greater scrutiny than it ever has in the past. So it's a good time to get your governance right. The final point in the table says that external auditors must be independent. We know that. We did that in the ethics chapter back in chapter 2. Internal audit. Well, ideally I'd like them to be independent, because when they come and give me their opinion on my risk management and controls, I want to believe that opinion. And if they're not independent, their opinion might be wrong. So if I take controls and risk management seriously, how can I improve the independence of my internal auditors? And one way to improve the independence of them is that if they are currently employees of the company, and they can never be independent, they work for us, they've got a clear self-interest threat not to highlight big problems, because big problems could mean the end of their jobs as well. Well, one way to make them more independent then is make them look like the external auditors and get them in from outside. Now we'll come on to that point in more detail in a minute or two. A bit more detail on the sort of things that internal auditors might do. They might be asked to look at risk management, look at different types of risk, for example, as it says on here. And they might be asked to look at the risk management process itself. They might be asked to measure risk impact, assess the likelihood of risks happening. They could even be asked to come up with solutions to risk. There are many of those, and a few of them are given at the bottom of the page. This page appears now to be less important for the exam. I would call it background only. Strictly speaking, it's never been taken off the syllabus, but ever since we've had the P1 exam, which has a lot of risk on it, governance, risk and ethics, your F8 examiner has shown much less interest in this. So I think that is fairly unlikely to come up. Another side of internal audit is the operational audit, and specifically value for money. A value for money audit is where we are asked to look at one aspect of the business, which could be, I don't know, the IT department, production department, or whatever. And we are asked to assess the 3 E's. Is that department economical, efficient, effective? What do we mean by those words? Well, if we start down at the bottom of the diagram up on the page, we start with economy. Economy means, could we be getting the same quality but cheaper? So could we replace Paul with a cheaper tutor and get the same level of quality? Of course not. Could we operate this studio with cheaper equipment and get the same level of quality? So it's looking at how much you are spending to get the result that you've got. Efficiency, on the other hand, says, once you've got resources, are you getting the most out of them? So you might look at how LSBF is using me at the moment and say that putting Paul on the internet, where he could be teaching to 7 billion people at once, is a very efficient use of his time. On the other hand, the studio I'm standing in has lots of quite expensive equipment in it. If we're not using these studios 24 hours a day, 7 days a week, you could argue we are not using them efficiently, because having invested the money in the studios, we should try to use them as often as possible. Effectiveness is about whether a department or a whole company is achieving its goals. So what are the goals of LSBF? Happy students, good reputation, high pass rates, win awards, students who want to come back and study their next papers with us, would all be ways of measuring if we're an effective college. An effective college has happy students who would recommend it to other students and who pass their exams. So there's a fairly straightforward example of economy, efficiency, effectiveness. The 3 E's are of course important for every organisation, and you would rather assume that in a profit-making company they're pretty tight on these things all of the time. If a company doesn't achieve its objectives, the directors and management will get sacked. It's especially important with government-run organisations, because the government is using taxpayers' money, and the danger is the government is not accountable to anybody and therefore spends way too much money, is horribly inefficient, because they can always raise taxes and get additional cash whenever they want. So value for money in the real world is a very important exercise. Make sure you know it. And just as I did a minute or two ago, make sure you've thought some examples. Just run through that LSBF example again to make sure you understand it. Now, I didn't turn to my left and suddenly loads of questions. If internal auditors may not be independent, then to what extent should external auditors rely on the work of internal auditors? What a very good question. The more independent the internal auditors are, the more the external auditors will be able to rely on their work. Keep that thought, it's coming up shortly. You can only use their report to carry out your external audit work. Not true. We can rely on the work done by the internal auditors and reduce our control testing by relying on their work, if they're reliable. If you are the external auditor, can you also be the internal auditor? No, Fiona. Mais non, madame. If you are internal and external audit, number one, you'd be getting a lot of fees from that client. Self-interest threat. Number two, if internal auditors are checking the controls and the controls affect the financial statements, when you do the external audit, you are to a great extent checking the system that you've been advising on as internal auditor. Self-review threat. It's too close. You cannot do both. In the past, some audit firms did, but now, no. Too much. It's all right. Perfectly sensible question to ask. Very good question, in fact. Shows you're thinking. Nothing wrong with questions. Now, in the previous chapter, we looked at external audit reports. A fairly minor point, but just be aware that internal audit reports are going to look different because they're internal. And because they are for internal use, they are likely to be a lot more detailed. Because now the shareholders aren't seeing this, I can get my internal auditors to be honest. If our systems are awful, tell me. No one else will get to read this, and I want to put our systems right. Okay, linked in with various questions we've just been dealing with. One way to improve the independence of your internal audit work is to outsource it. And one of the other advantages of having more independent internal auditors, let's add it on the end since you've just said it, it increases the ability of the external auditors to rely on the work of the internal auditors. Because if they are more independent and more experienced and they are qualified experts, that makes them more reliable, doesn't it? So the benefit to the company is you get high quality work done by experienced, qualified people. They're more independent, better reports, and your external audit cost might come down a bit because the external auditors are more likely to rely on the internal auditors. Also, of course, another benefit is you don't have all the costs yourself. One of the reasons for taking taxis everywhere is you don't have to pay for a car. Not just buying it, but having a garage to store it in, putting petrol in it, fixing it, cleaning it, polishing it. However, this all sounds way too positive, doesn't it? And yes, there is a downside as well. If you phone up Ernst & Young, Deloitte, KPMG, PwC and all these big firms of accountants and say, hello, I need 3 hours of internal audit, how much will it cost? You're going to be paying not just the cost, but their profits as well. If you don't need that much of it, a bit like taking a taxi, it's worth the expense. If you need a taxi every day, buy a car. If you need internal audit every day, it might be cheaper to have your own staff doing it. So it can be rather expensive. If you are going to hire an outsourced provider, you will need to keep an eye on them and make sure they're giving you the service that you want. And it's harder to monitor people when they work outside of your company. Then you've got to go and find an audit firm. And that's going to cost you money. If you have outsiders looking inside your company, the risk of confidentiality breaches, I agree, is higher. Cultural differences, because they might not do things or say things the way your company works, whereas your own staff would fit in better. And down at the bottom, if you've had a fraud be discovered this morning and you have your own internal staff doing internal audit, you can tell them, investigate it now. If you phone up Ernst & Young and say, we've had a fraud, investigate it now, there's a danger they say, all our staff are busy, we can send you someone in 2 weeks. If you need to get somewhere fast and you've got your own car, that's good. If you need a taxi, you're going to have to wait for one to turn up. So there we go, the pros and cons of outsourcing internal audit. Almost finished, guys. Relying on internal audit. It feels like we've covered this already. And we have. For a couple of reasons, really. We've talked about relying on experts before. And external auditors relying on internal auditors is just another example of relying on experts. And secondly, when we were going through independence, you asked about relying on internal auditors, so we've sort of dealt with it already, I suspect. Sorry, getting ahead of myself there. Now there's two angles to this, relying on internal auditors. Two angles, and I think since this is the final thing in the notes, let's go down and have a bit of extra. Two angles. Number one. The internal auditors of the company have tested controls all year. And that raises a question. I, as external auditor, also need to test controls. So does that mean that instead of doing loads of tests myself, I can pick up these guys' results and rely on them? And the answer to that question is, yes, I can. But, there's always a but, isn't there? If internal audit appear to be qualified, experienced, and independent, so I would have to assess all of those as with any expert, and I can't just pick up their results and rely on them. I should re-perform a sample before I rely. So that's one angle, but there is another one. What if I turn up at my client and my client has their own internal audit department and their staff are not that busy? can we borrow the client's internal audit staff to help external auditors do the final audit work? Can they help us and join our team? And maybe slightly surprisingly, the answer to that is also, yeah, you can. If well, you better make sure they are worth borrowing. And secondly, we must only use them for low risk, low materiality, and non-subjective. So anything that's a matter of judgment, opinion, no. But where you've got some relatively basic audit work to do, stuff that takes time, but which frankly anyone who's reasonably sensible and competent could quite easily do, why not use them? I mean, they're auditors, they understand the process, why not? So as you can see, because that is the end of the notes, yay! Oh, look at that timing, bang on 8:30, well done me. As you can see from what we've just done, the internal audit chapter, chapter 10, has got little bits of knowledge, hasn't it? What does internal audit do? Why is it useful for corporate governance? Internal audit versus external audit. Why might a company need internal audit? Should it outsource internal audit or keep it in-house? Can external auditors rely on internal auditors? Value for money auditing, what's that all about? So you can see this chapter's got 6 or 7 different bits of knowledge in it, and typically we would expect at least 1, possibly 2 of those bits of knowledge to come up. But it's knowledge. So my advice for chapter 10 is learn it. Have a little list of those 6 or 7 areas on a sheet of paper, but don't write anything down. And practice staring at one of them and thinking, right, if I had to write 3 or 4 things about that, could I do it? It's pure knowledge. I think that makes it quite difficult because it's not the most exciting area of the course, and with no practical application, it's quite boring to get it into your head, but I'm afraid you have to. Now we have reached the end of the tuition phase. Yay! We have got a mentoring session. Off the top of my head, I cannot remember when it is this week, but it's this week at some point, I think. We have a half an hour mentoring session, and in that Q&A session, a couple of things we need to do. I will use that Q&A session to summarize what we have done on the course and where your key areas for revision are. But equally, it's a Q&A session, so a chance for you to ask about anything you have seen on this course. Oh, thank you. Thursday, is it? 12th. Okay, good. I'll see you on Thursday then, won't I? So, very, very important, an opportunity for you to ask any questions at all before revision kicks off next week. Now, I've always found the key with this paper is make sure you've got the basics sorted as far as you can, so that when I start going through questions, which is what revision is largely about, you get the most out of them. And you're not just staring at them going, yeah, but what does that word mean? And oh, I don't know that. So try and make sure the knowledge is there. Now, I will cover more of this on Thursday, and thank you everyone for telling me it's Thursday. Yeah, it's good to know we all agree. Hopefully by now, you've got this course. Yes, there is some knowledge. Of course there is. But the key skills that get a lot of marks on this paper, there are 3 big ones and a couple of others, so let's say 5. You've got to be happy explaining ethical threats, audit risk and response, internal controls, objectives, procedures and tests, substantive tests, and audit reports, including those 7 outcomes you've just seen tonight. So please make sure that you have a look at those 5 areas in particular. Start getting the knowledge in, but you've got almost a month to shovel as much knowledge into your head as possible. The skills take a bit of time to practice. Well, lots to do indeed. Glad to hear that you guys are happy, which is, I guess, my job. This is like a VFM value for money exercise. Has this been effective? Well, so far so good, but I guess we'll really find out on January the 18th, won't we? Okay, well, up on the screen we have our summary of the final things we've been doing in the notes. I've pulled out some of the more important audit standards from Chapter 8. Do take a look at subsequent events. It's not something that will sit in your head after the first look. 7 audit report outcomes. Make sure you've practiced those in your head as well, so that when we come to write the answers, you're there or thereabouts. And with internal audit, it is just pure knowledge, I'm afraid. Not very exciting, but thankfully, it is not usually worth too many marks. Thank you all for your time and efforts and for having some conversation and asking some very sensible questions. For now, it is time for me to say bye-bye. I will see you on Thursday for mentoring, and hopefully I will see as many of you as possible on revision starting next week. Revision for a practical paper like this is critical. I don't get to look at much in the way of questions during tuition, but on revision, it's questions, questions, questions. So thank you all for your time. Any queries in the meantime, feel free to email me. I hope to see you all on Thursday. Good night.